JP Morgan closed their short position in silver at the exact market bottom on Friday. The exact bottom, not close to it, not near it. The precise lowest point in a 35% intraday collapse. The worst single-day crash in silver in 44 years. And while every mainstream outlet on earth is telling you this was about the Federal Reserve Chair nomination, about Kevin Walsh, about hawkish monetary policy, they're lying to you, not by accident, by design. Because the real story, the actual mechanism that caused 35% of silver's value to evaporate in 24 hours, is something they desperately do not want you to understand. This is the story of what actually happened on Friday, not the cover story, the real story, the margin hikes, the exchange going offline, the forced liquidations, the engineered flush, and why this exact pattern has happened 4 times in modern history. 1980, 2011, December 2024, and now, same playbook, same players, same outcome. And if you hold silver, gold, mining stocks, or any precious metals exposure, you need to understand every piece of this before markets open Monday. Let's start with what they want you to believe. On Thursday, silver hit $120 per ounce, all-time high, historic. By Friday afternoon, it was at $78. A $42 drop, 35%, in hours. Gold fell 12%. $3 trillion in market value wiped out across precious metals. The story you're being told is simple. President Trump nominated Kevin Walsh as the next Federal Reserve Chair. Walsh is a hawk. He wants to shrink the Fed's balance sheet. He wants tighter monetary policy. He signals less money printing. And since gold and... Here's what actually happened. And you can verify every piece of this because the data is public. It's just not being reported. First, the Chicago Mercantile Exchange, the CME, where silver futures trade, raised margin requirements aggressively, multiple times, right before the crash. Margin requirements are how much cash you need to hold a leveraged position. If you're trading $100,000 worth of silver futures, you don't need $100,000. You might only need $10,000, that's 10 to 1 leverage. But the exchange can change that requirement anytime they want. They can say, we don't want 10% anymore, we want 20%, or 30%, or 40%. And when they do, every trader holding a leveraged position has 2 choices. Add more cash immediately, or sell. Close the position, get out. And here's the critical part. The exchange knows exactly how much leverage is in the system. They know how many traders are fully maxed out. They know what price levels will trigger forced selling. They have all the data. And on Friday, they used it. Second, the London Metal Exchange went offline. The London Metal Exchange is the second most important venue in the world for silver trading, and on Friday, during the crash, it went offline. Systems down. Trading halted. Now, let's talk about JP Morgan. JP Morgan has been short silver for years, documented, proven, fined multiple times for precious metals market manipulation, not alleged, convicted. They paid fines, it's public record, and on Friday at the exact bottom of the crash, $78 per ounce, JP Morgan closed their short position. They covered. Bought back everything they'd sold short at the lowest possible price, the absolute bottom tick. How do you do that? How do you close a massive short position at the exact lowest point in a 44-year record crash unless you know exactly when and how the crash is going to happen? You can't. It's mathematically impossible. Unless you engineered it. So here's the full sequence. Step 1. Raise margin requirements to force leveraged traders to sell. Step 2. Take the London Metal Exchange offline so half the global market can't participate. Step 3. Take HSBC systems offline so the second largest short can't interfere. Step 4. Wait until Asian markets close so the largest physical buyers in the world are locked out. Step 5. Drop the Fed chair news as the catalyst. Step 6. Let the algorithms do their work. Margin calls trigger stop losses. Stop losses trigger more margin calls. The cascade begins. Prices collapse. And at the exact bottom, the big shorts cover. JP Morgan. The commercial banks. Because this pattern has happened before. 4 times. Exactly the same way. 1980. The Hunt brothers tried to corner the silver market. They bought massive amounts of physical silver and futures contracts. Silver went from $10 to $50. 10 times increase. And then the exchange, the same exchange, the CME's predecessor, implemented new rules. Rule number 7. You could only sell, you could not buy. Buying was restricted. Only selling allowed. The Hunts couldn't meet their margin calls. Silver crashed 80% from $50 to $10 in months. The little guy got wiped out. The big shorts covered. 2011, post-financial crisis. People lost faith in banks. They piled into gold and silver as safety assets. Silver went from $18 to $49. And the CME raised margin requirements 5 times in 2 weeks, 5 times in 14 days. Leveraged traders got flushed out. Silver crashed 48% from $49 to $25. Same playbook, different excuse. December 2024, silver hit $84, all-time high at the time. The CME raised margin requirements twice during thin holiday trading, when volume is low, when liquidity is poor, when small moves create big price swings. Silver crashed 13% in days and then recovered. So the question you need to answer is simple. Is this the 1980s, where silver took years to recover because it was a speculative bubble with no fundamental demand? Or is this December, where silver recovered in weeks because the physical market has a structural supply deficit that paper market manipulation cannot solve? The answer determines everything. If this is the 80s, you sell. You get out. You wait years for a bottom. If this is December, you buy. You accumulate. You position for the recovery that happens in weeks, not years. And here's why I believe it's December. The fundamentals have not changed. The paper market crashed. The futures market got flushed. Leveraged speculators got wiped out. But the physical market still has the same problem it had on Thursday. There is not enough silver. We are in the 5th consecutive year of a 200 million ounce annual supply deficit. That's 1 billion ounces total over 5 years. The supply deficit did not get solved by a margin hike. It did not get solved by exchanges going offline. It did not get solved by JP Morgan covering their shorts. The physical market still has a shortage. And the physical market is where the real price gets determined long term. The paper market, the futures contracts, the leveraged speculation, that's where they can manipulate. That's where margin hikes work. That's where forced liquidations create crashes. But they cannot print physical silver. They cannot create bars and coins out of nothing. And the physical premium, the amount people pay above the paper price to actually own silver, is at all-time high. So what happens next? History gives us the pattern. After these engineered crashes, there's always a relief rally. Dead cat bounce. Buyers step in thinking they got a bargain. Prices recover 10, 15, 20%. The media says the worst is over, and then the real move begins. Either it's a full recovery back to highs and beyond, like December, or it's a long, slow bleed lower, like the 80s or 2011. The difference is fundamentals, and right now, the fundamentals are the strongest they've been in decades. Industrial demand is structural. Solar panels need silver, electric vehicles need silver, AI data centers need massive amounts of silver for electrical components. This is not speculative demand. This is industrial consumption, and it's not going away because the Fed chair is a hawk. Here's the other piece nobody is talking about. The paper market is being dismantled, not by choice, by necessity. These margin hikes are not temporary. They're not going back down. The CME is making it impossible for small traders to participate in silver futures. They're killing the paper market for retail. And when the paper market dies, all that's left is physical. And physical has a supply problem. This crash is not a bug. It's a feature. It's the reset, the clearing out of leverage, the forced liquidation of speculative positions. And when it's done, the physical market takes over. And the physical market is in deficit, structurally, permanently, until either demand drops, which is not happening, or supply increases, which is not happening, or the price goes high enough to ration demand. So here's the timeline as it stands. Monday, we see if the relief rally begins, buyers stepping in, media saying the worst is over, short covering creating upward pressure. Tuesday through Friday, the real test. Does the rally hold? Do fundamentals reassert themselves? Do physical buyers step in at these prices? Next 2 weeks, the pattern confirms. Either this is December and we recover to $100 and beyond, or this is 2011 and we bleed lower for months. My assessment, based on fundamentals, based on the physical market premiums, based on industrial demand, this is December, this is a flush, a reset, a clearing of leverage. And the recovery begins within days to weeks, not months to years. But understand this, they will do this again. As silver rises, as it approaches 150, 200, whatever the next level is, they will engineer another crash. Margin hikes, news catalysts, exchange outages. The playbook is known, the pattern is clear. The only question is whether you understand it well enough to not panic when it happens. Because if you panic, you lose. If you sell at the bottom, you lock in losses. And someone else, someone who understands the game, buys what you're selling at the price they engineered. This is not a free market. This is a managed market.